the prediction for 2026, Tim.
I think that Apple's going to have to make a big AI acquisition. And I think SpaceX will be the first of those, big five to go public. Those would be my two capital markets predictions. Those are always the ones that are a little easier to measure, like it either happened or it didn't happen. So I'll say those. And then I will say that the adoption of agentic AI in the enterprise will be meaningfully, measurably higher across the course of the year, across all these use cases we've mentioned and more.
Welcome to the Startup to Exit podcast, where we will bring you world-class entrepreneurs and VCs to share their hard-earned success stories and secrets. This podcast has been brought to you by TIE Seattle. TIE is a global nonprofit that focuses on fostering entrepreneurship. TIE Seattle offers a range of programs, including the Go Vertical Startup Creation Weekend, TIE Entrepreneur Institute, and the TIE Seattle Angel Network. We encourage you to become a TIE member so you can gain access to these great programs. To become a member, please visit www.seattle.tie.org.
Hello, everyone, and Happy New Year. Hope you are off to a great start in 2026. As you may know, at the beginning of every year, we host an investment outlook panel with some of the top investors in Seattle and Bay Area to understand the major trends in VC investing. Today, we are very pleased to have with us Tim Porter, who's the managing director at Madrona Ventures, a top VC firm based out of Seattle. Sudip Chakrabarti, a partner at Pruven Capital, which is an early stage investor in enterprise IT software from the Bay Area. Kellan Carter, a general partner at Fuse VC, a major early stage VC in the Seattle area. And Joaquín Gallardo, a senior VP at Silicon Valley Bank, a major venture debt lender for startups. So with that introduction, over to you, Gauri.
Hello, everybody. Welcome to our annual Investment Outlook episode. Our first guest is Tim Porter from Madrona Ventures. Hello, Tim. Welcome back to our annual edition of Investment Outlook episode. You have now done it from the very beginning, so we look forward to hearing your views on 2025 and what to look for in 2026. First, right off the bat, describe 2025 for you. How was it? Was it different than 2024? How was your scorecard that you shared with us at the beginning of 2025? How was it for at the end of the year?
Yeah. Well, you'll have to score me on what my predictions were last year. First of all, thanks so much for having me back. It's always a lot of fun. I feel fortunate to have known you, Gauri, for a long time in this tech ecosystem. And it's always a pleasure to be able to have a chance to talk with you and Shirish. So thanks for having me back.
So thank you. Kick off with 2025 and look back first.
Yeah, it was a busy year. We made a lot of new investments, I would say, which we're excited about. Obviously, there's a ton of innovation happening in the market. If anything, compared to like what we thought our pace would be, we were hot. We were in some ways pushing the comfort level of the number of new investments. I think we invested in 25 new different companies. This doesn't, count follow-on rounds, which is probably normally it would maybe be 16 to 20. We did 25. I think almost $100 million of new investment, not counting follow-ons. And so that's a busy year. And we saw a lot of things happening. The pace of new company formation, both in the Pacific Northwest as well as across the country and the world, is very high, with very high quality. And then you have a bunch of companies that are doing really well. And so that leads to, later stage opportunities as well. So as you think back over these last years since the pandemic, there was a period where, there wasn't much happening in the later stage land, but new companies kept getting created. And now this past year, we've seen a period where there's lots of new company formation and a bunch of companies doing well, and a lot of capital and a lot of opportunity. That brings us challenges. There's also a lot of noise and high prices and, what's durable, things we'll probably talk about. So it's not like it's easy, but it is exciting.
So since the pace of investment went up, was it all primarily driven because now there was AI was delivering on promises that startups could really start digging into it? Because there was all this noise in 23 and 24 and people are trying to sort it out. Was 25 defining that you guys felt like we have to invest more in terms of number of transactions?
Yeah, AI is definitely. I mean, gosh, like what's not AI? In some, AI is software. We're software investors, so it's almost hard to decouple. But it wasn't 100%. I would say we made some investments that were in businesses that weren't purely created for AI. Even those, for instance, we invested in a company called Revive that helps e-commerce and retailers with returns, and then how do you take those returns and sell them again or recycle them or do whatever's most efficient. And they definitely use AI to do some of those things, more efficiently and to run their business operations, but it's not an AI company. So that's a massive trend that doesn't involve purely AI. But most of the businesses that we invested in were taking advantage directly of AI. It could be, an AI native company in the sense of this company would have never been built if there wasn't generative AI. And then there's a lot of other ones that are, reimagining long-term, parts of the business or parts of software where now with AI, you can reimagine those workflows, do more automation, find insights more quickly. So that is definitely the bigger driver on our later stage investments. And just to remind people, we're kind of from formation stage pre-seed through Series B. About 25 to 30% are like those pre-seed right at the start. About 50 to 60% are those, whatever your second round is called. And then about 15% of the deals are those kind of Series B stage. That turns out to be more like 35% of the dollars, but only 15% of the deals because they're bigger checks. So those later stage ones where we're writing our initial check, those were largely companies that had grown very quickly using AI. So one of them that's in California that I'm thinking of is called GrowthX, and they help companies do lead generation and marketing automation using AI. And a big part of that is how do you use these generative engines, ChatGPT, et cetera, to find customers. Who we all do this in our life, right? You want to buy some new product. What do? Like you go in ChatGPT and ask it like, which one should I consider and what's better and why? So that's a new place to find customers, not new in 2025, but new in the last 2 years. And GrowthX is a company that's gotten expert at using those AI tools to help companies do marketing automation and was growing like gangbusters. That was one of the companies that we invested in out of our acceleration fund.
Right. So since Madrona as a fund invests at every stage, you're stage agnostic, but you're, you are more founder centric, if I could use that word, right? Has the valuations shifted in 2025 because this AI layer got there? People can build faster or maybe show growth quicker. There was a catalyst that was not just capital. Capital was a huge driver of growth. Looks like you could grow before even you take meaningful capital. Therefore, are founders coming in with different valuation expectations at any stage?
Yeah, I'd say valuations are running hot. But I'll give some nuance to that.
Mhm.
So at the very earliest stages, new companies, there are certainly deals that I would say with good founders in good spaces using AI, where the initial, pre-seed round is, 13, 15, 18, 20, 25, which I mean, you and I remember days when those deals got done in, single digit, pre-money, but, in that 15 to $25 million range, that doesn't feel overheated, for good founders, in a good category. But then there's other ones who, because of the track record, the case, whatever, where you see somebody right out of the box, raising 50, $60 million at, 300 million. You got to really believe that that's going to be a big outcome to like consistently, make good returns for your shareholders, when initial money is going in at hundreds of millions. And so that dynamic of seeing like initial rounds, I think somebody I saw article called it instead of a seed round, a coconut round, because of the size of the, the size of the check. I think that's a sign of the times. And part of it is that once these companies start growing, a lot of them are growing really, really fast. So the older days of like, if you triple, double, go public. Now it's like, 1 to 10, instead of, 1 to 4 or something like that. And so if you don't get in soon, it gets even more expensive. And you sometimes can truly justify, a higher price based on if this company keeps growing this quickly, we'll grow into it, in 1 to whatever number of years. But then there's also a lot of FOMO, and you alluded to it. There's just a lot of money and a lot of firms chasing, these deals. And when you have companies like certainly OpenAI and Anthropic on the far outlier end, of success that are reaching, hundreds of billions of dollars of valuation, you can justify like, well, this might seem expensive, but guess what? This could be a $30 billion, $50 billion, $200 billion outcome. You can justify a lot of things. So, and I think in this market, you are absolutely going to see more winners like that created, historic companies that couldn't have been created before, but then there's going to be tons of losers. Like it's the story of venture forever. It's a power law where you have a smaller number of winners and a larger number of losers, but it feels like in this market, it's amplified. That power law is amplified where you're going to have even bigger winners that everybody chases, and you're going to potentially have even more losers just because of the sheer number of companies and the amount of capital that's going into them.
You alluded to IPOs, right? You just said, usually people went down the path of exit, right? There's an investor exit, not company exit, investor exit. We've not had much in the way of big IPOs for a while, a few years, right? There's some signs that it could come back. Is your belief the economy, macroeconomic conditions are ripe for it, or maybe it's regulatory? Could you talk a little bit about, is this 2020's time when you predict IPOs could make a comeback, and also your views on the macroeconomic conditions to make any of it possible, whether it is exit because of IPO or is it M&As could happen more? Both of those were quiet for a bit, if I may.
Yeah. I mean, we really have had a 4+ year drought in tech IPOs. There've been a few, but not many. And so I do think this is the year that dam likely breaks. And, there's 5 mega companies that everybody's watching. OpenAI, Anthropic, Stripe, Databricks, and SpaceX. I think it's highly likely that at least, 2, maybe more of those go public this year. These are all, more than $100 billion, and in some cases more than $1 trillion potential market caps. I think those will be, just massive bellwethers for the overall market. If those go well and start to, one after the other, I think you'll see even a lot more. I'm hearing from my banker friends that the backlog and the activity, the private file and people getting ready is like that activity is really picked up in a bunch of names of companies that are far along that aren't, one of those 5 mega names. So I do think we're going to see a big uptick in IPOs this year. We'll see. I would have to, if I had to pick, I would say, probably SpaceX or Stripe would be the first, of those to go. But the ones that'll be most watched, well, they'll all be highly watched, but OpenAI is kind of the one that's the biggest one. I also see, so M&A is always harder to tell. I would say just within my own portfolio, Madrona's own portfolio, there's more activity for sure, including some of more size than the small M&A kind of never goes away. A few different things. I think you see bigger companies who want to buy, businesses, products, talent in AI. You see the AI companies, voraciously buying. We sold StatSig to OpenAI last fall. That was a big transaction that was really meaningful for both sides. And so I think you're going to see more activity kind of across the board. The other one is I think you'll see more of these private to private mergers, where you have private companies that are of reasonably meaningful scale, perhaps could have been public companies in years gone by, where now the bar for kind of size plus growth rate plus profitability means that some companies will need to combine, which is always easier said than done. There's lots of pitfalls into doing that successfully in order to create, a big enough asset with good enough margins, take advantage of the synergies, et cetera. So I think that's another thing you'll see more of this year.
What about the economy in general? I know that that's not a driver for investments, but you generally watch it because at the minimum, it's something that everybody takes into account from an emotion perspective. So is it better now? Because there's a lot of change happening.
Man, I know we don't have a crystal ball. Like, as you alluded, we think about we're going to invest. We're going to have 8, 10, 12 plus year time horizons on our investments, and you're going to have up cycles and down cycles. And to be successful, you can't just try to time what's happening in the macro. But to your point, of course, it all trickles down. It all matters. I would say, so let's think back beginning of last year. I think we had a position, I probably said it on this podcast, that it was going to be a more aggressive risk on environment. And then the first quarter plus was a very much like, oh my gosh, there's so much volatility. Everyone was sort of frozen. But then as you got to mid-year and the second half of the year, you saw a lot more of this aggressive risk on, investments that we talked about, M&As starting, et cetera. I think where you are now is it continues to be an aggressive risk on environment. There's capital flowing on the investment side. Enterprises are spending money. There's these super exciting, new AI services. I think that's all happening in a weird backdrop where it's just like there's so much geopolitical, in my opinion, kind of awfulness, happening out there that it feels weird sometimes. You're sort of this tech, you're operating in this like ripping market, but yet there's so much uncertainties. I think we're just putting our head down and working. If we start to see the, budgets shut or economy change or something, we need to be able to be nimble. In the meantime, we just think there's a lot of opportunity to keep driving towards. And then I think this whole question of like, is there AI ROI? Is another interesting one. So like set aside the geopolitics, is like this AI stuff really work? And I think we're kind of in the natural part of the adoption cycle where people realize like it's easy to demo this stuff. It's hard in production. There's lots of things you have to get right. And that's going to cause some use cases and some implementations to not be, a panacea, on day one. But I think we're already seeing a bunch of use cases in places that you do get incredible ROI. And so we're long-term believers in that, and that you're going to see amazing ROI from AI broadly, even if specific use cases and implementations and things in the enterprise, there's a crawl, walk, run aspect of it. And we could talk more about some of the places that we're seeing a lot of, obvious ROI and some of the places where it's probably still early.
Let's kind of look at, you're going to make, let's assume you make the same number of investments this year in the early stages, 25 or so. Is this then the year the agentic takes root? Because you as a venture fund have really been on the intelligent application thesis for a long time. This is even pre this AI run, right? You guys have always believed in intelligent applications and of course founder fit. These two have been cornerstones of your investment. But as agentic is taking root, and therefore your intelligent application thesis now really blossoms into exactly what AI's promise might be from an investor perspective.
I think so. And I think to my earlier point, it's a continuum. And so it's not in all use cases and categories simultaneously. But I mean, take a few examples, right? So in cogen and in developer tools, I mean, it's incredible adoption and incredible efficiency and incredible ROI. The growth of companies like Cursor, I think you are seeing what I would call, truly intelligent agents, things like Devin, from Cognition. Now, even this is complicated because the difference between writing, more lines of code faster doesn't mean, you're necessarily shipping quality working things faster to customers. And that's the only thing that matters at the end of the day. So, but I think, we've seen lots of examples of just things being built in timeframes and in ways that they wouldn't have been never possible before. So I think that's an area of clear, deep adoption and benefit. External customer support. Areas where, historically there were things like IVRs that like everyone hates, like, AI voice agents way better, right? And you can sort of the language which you want, take you to the right place, answer your question. If it's available in the database, it's actually a better experience and companies save money. So you have, companies like, Decagon, growing really, really quickly. That's not one of our investments, but there's a set of companies in that space that have done, extremely well. I think AI for legal, that you're seeing a lot of adoption in law firms and now in internal legal departments where redlining and contracting and workflow, I think there's a lot of adoption and ROI there. Some of the areas we invested in that I think are coming and internal support. So internal service management, we invested in a company called Ravenna here in Seattle that helps automate creation and tracking of tickets, answering questions for employees. And I think that's neat because that model that IT's used for a long time. Like you've got a question, we log a ticket, we resolve it, we track how many we resolved, how long it takes. That's kind of how all of us work. Like you need a question from sales, you ask sales, you need a question from legal, HR, but it's more ad hoc. I think AI provides sort of a system of both record and action. And a company like Ravenna AI is providing that for all types of internal service management and support. I think, autonomous GTM is another interesting area around sales. I think you could argue that this whole, there was a lot of adoption, for instance, on things that was like AI SDRs, like, hey, I don't need a person anymore. My AI is going to send all these emails and convert and all that. And while that is kind of true, there was also a lot of like, whoa, that was a lot of spammy email that didn't really help. So that, I'm not that. On the other hand, broadly around, there's too many tools in sales. It's not automated enough. How do you bring those things together? One of a company that we invested in, I work on Clarify AI, autonomous CRM that's all in one across your call recording, outreach sequences, data enrichment, et cetera. So that is a big theme on like, how do you make it easier for enterprise adoption? And it's an interesting time because you have this wave of LLMs. You had a bunch of companies that were pre-LLM. You've got some companies that were super early in LLM. And now in some of these categories, you're companies that are starting right now where it's like, okay, now the tech is really ready and you can build the product exactly to meet customers where they are to create this magic. And so you see a little bit this fast follower, and some of those now are the ones that are really taking off.
So talk a little bit about founders, right? Because you guys have really made that the cornerstone of your investment, right? Of any investments that you make. Founders today need to not only have good engineering or technology capabilities, but looks like they need to understand go to market much, much earlier than they ever would have in the past, because there you kind of made strides, worked on it. Now you're scaling. You got to figure this out quickly. Otherwise, somebody else has figured it out. Do you see GTM as becoming a moat in itself than just pure technology? Or is this accelerated GTM that's getting there that founders now need to have that skill on day one? It's not like we can hire somebody, we'll learn this, we'll build a good product. From a investment perspective, how has that come into play for you guys, both looking back and looking forward?
Carl, you broke up a little bit in the middle of that question. So if my answer doesn't hit it exactly, we can edit back here, but I'll jump in. So I think you're right. We're at the end of the day, AI automation, it's still about the founder. It's still about people. And while AI can create a lot of efficiency, it doesn't create true intelligence. It's another tool to go faster, to be more efficient. It's not going to make you successful on its own. Specifically in the area around go to market, it has, I think it has evolved. I think you need to, as a founder, understand how you can adopt some of these tools to find initial leads. The way that you can do founder selling, I think in some ways can scale a little farther and be more efficient. Before, for instance, you have to hire your first salespeople or expend some of the traditional marketing budgets. So I think, being smart about how do you leverage AI in all parts of your business, probably particularly go to market, given many founders that we back are technical product people, right? And we'd love to, it's like have the idea of the problem, how to build the beautiful solution. The selling, part of it is often okay, now how do we go either learn that or augment that, or, et cetera. So I think that leaning into how you're using AI across every function, particularly go to market, particularly in the early days, is absolutely a critical success factor. But it's also one that we feel like we can help founders, and that you can come up to speed.
So this leads to the other important question, right? Is the moats changing? Meaning you now need to have many things. You can't just you need to understand the vertical. You need to understand the workflow. You need to build a technology. You need to have go to market. Seems like now the founders have to assemble different kind of teams than they might have in the past. Where in the past could be, I'm going to hire 10 engineers, right? Raise capital and hire 10 engineers. Looks like you got to hire a mix even on day one, because design, UI, all of this is becoming important, because my assumption is that the coding is now less compared to in the past where you had to code like hours, you code much less. How is that changing? Or what is your opinion? If A, is it changing? B, are you looking for that change as an investor?
Yeah. So interesting time kind of moat, and how do you create like durable competitive advantage? And then also, how does that imply you build your team? Which I think they are definitely related to your point, but they're also somewhat, there's also some separate considerations. So, we have this AI conference in the fall, and the founder from a company called Neon that was bought by Databricks for a lot of money. This question came up about moats, and his point, which I think is interesting and largely true, is in this world of AI, the only moat is speed. The only moat is execution, and how you are constantly making whatever is the latest innovations in AI work for you, and without chasing shiny objects, right? That's the challenge. It's like if you just sort of jump on whatever the new thing is this week, you could chase your tail. But if you ignore, the new things this month, then you're going to fall behind. And so I think that's what the best founders need to do. And so I do think fast execution is paramount. And that comes to what's the team you build around you to accomplish that fast execution. I would also say, and I'll come back to the team on moat, you can still create data flywheels in your business that create a moat. That either you take advantage of a data set that your customer has to then create more data that makes your service better, et cetera, et cetera. So I do think that that's a real thing. There are classic advantages around, building brands and building community, network effect kind of moats. And occasionally, there are technical moats. I think there's always been this, like, there's no real technical moat because Google or Microsoft can build anything, if they decided that they wanted to do that. I do think that notion is probably even more so that way, that anyone can build anything. But we also are still seeing founders who are doing things we think in novel ways, or in some of the businesses that are more deep tech, type things. On the makeup of the team, I think it's true. Like, it's like the sheer number of engineered bodies you need to do X is probably less. Or the end might be similar, but what they're doing is different. This idea of, more architect thinking, more versus sort of just like go write the code. I think there is a little bit more of a shift, to that side of things. People who are smart about how you review the code, not just write the code. But on the other hand, depending on your category, still getting some critical mass of people that are just really, really deep in that area of technology, whether it's search or whether it's, healthcare, or whether, whatever your domain is, I think still matters a ton. And so, I'd still hiring engineers is probably the hardest, one of the hardest and most competitive things that founders have to do. And it still matters a ton, and getting that right mix of, when you hire the right on go-to-market side without hiring too many, and right ways to complement. It's just as tricky as it was when you were building your first company, Gary.
Yeah. The hiring engineers is tougher, I think, because they're employed at, say the Mag 7 or even the Mag 20. I mean, the next 20 of them. The value of their of their options, or their overall value of those companies, is so big at this point. You got to really think. And now I feel like these companies are hiring like NBA athletes or NFL athletes. I mean, you hear numbers. I mean, Sam Darnold is getting the same deal as AI engineer. Like, that's just incredible. And I mean, as an investor, you got to sit back and say, "Wow, this is a whole different ballgame," isn't it?
For sure. And again, it's like it's a real power law. Like, some of these top AI researchers, like, yes, the numbers are just absolutely staggering. They're what would have been like a career making acquisition. Buyout number for an entire company could be for one top AI engineer. But then there's other parts of the market where there's a lot more folks available, and then you have things like Amazon and Microsoft keep shedding, in Meta they keep shedding engineers, and so it's a weird. So sometimes you talk to folks who are like, I'm having a hard time, and other times a hard time like finding the thing. It depends on your field and your expertise, but certainly if you think you're going to go pull people out of OpenAI or Anthropic or in one, like, good luck with that. You got to find some more creative way to do it. Outside of the people who, are mission driven and, getting in early, it's more risk, but you can also make an amazing, life-changing amount of money if you believe in the mission and are willing to dive in.
Right. So now we are on to the all-important prediction. The prediction for 2026, Tim. You can make any number you want, but we need a lead one from you. The first prediction that you will make for 2026.
I think that Apple's going to have to make a big AI acquisition, and I think SpaceX will be the first of those, big five to go public. Those would be my two capital markets predictions. Those are always the ones that are a little easier to measure, like it either happened or it didn't happen. So I'll say those. And then I will say that the adoption of agentic AI in the enterprise will be meaningfully, measurably higher across the course of the year, across all these use cases we've mentioned and more.
With that, Tim, thank you very much again for coming on board, and we'll have you on next year. But I'm sure that we will run into each other at many of the events during the year. Thank you very much for your time.
Thanks, Gary. Really enjoyed it. A lot of fun.
Yeah. 1 second. Hi there. Thanks for the support. Make sure to subscribe on your favorite app. Just search From Startup to Exit to stay updated. Now back to the show. Well, we have Kellan Carter for our annual Investment Outlook podcast episode. Kellan, thank you for doing this. This is third year in a row. Our audience is always excited to listen to your predictions and then see how much of them came true the next year. So with that, this is the hottest year of AI that you've been predicting this for 2 straight years. Let's start with looking back first, right? What was 2025 like from a investment perspective compared to the year before that? 2024 versus 2025.
Yeah. So first of all, thanks for having me on again. I always love doing this podcast with you, and honored that you continue to invite me on. I start to call it internally the annual "Put My Foot in My Mouth" podcast because, if I had a crystal ball, maybe I would start a company instead of being an investor. But if I look back and reflect on 2025, the thing that is hard to imagine every single year is that the pace of innovation continues to accelerate. You had the first wave of ChatGPT, and then the next generation of AI research labs. And it was always hard to fathom, okay, things could change even that much faster. And the pace of innovation and the pace of change is only accelerating. And, I look back during the SaaS era, and Uber's a great example where they wanted to start building self-driving cars because they viewed that as an existential threat to their ride-sharing business. And that time frame was really 10 to 15 year time frame of when they had to think about the next act that would be disruptive to their business. Now this is happening in years and even months sometimes. And so the speed of how companies need to evolve is only accelerating, and it's hard to keep up.
The thesis was AI the primary focus of your investment thesis in 2025, or did you have other theses in addition to AI?
Yes, primarily AI solutions, mainly vertical AI solutions. And what I mean by that is things not in the direct roadmap of OpenAI, Anthropic, Gemini, et cetera. And so we like verticals that are completely getting reinvented with AI at its core, because new business value could be delivered. Things in insurance, things in freight and logistics, even healthcare and delivery, where there's just a lot of workflow and FUD and process and documents that AI could help clean up a little bit and make the delivery of value that much better. Interestingly enough, we've taken an interest in space over the last couple of years, and now have a couple companies in space, one that helps manage satellites in space, one that's putting data centers in space. And we made this investment before Elon started talking about it. And so we're proud of that and really excited about the Star Cloud company. And we also have a defense company in space called Portal Systems, which helps satellites maneuver versus being static on their orbit. And so we've taken an interest in space, and I think Seattle is a really interesting hub for space innovation because Boeing was an original anchor tenant of major companies here.
Overall, how did you see valuations compared to 2024 and 2025? Were they impacted? Is capital plenty, therefore the valuations were high, low, same?
The valuation market has been probably one of the most unpredictable markets in my 13 years of doing venture, honestly. If I look back in the era of SaaS, if you hit a number, you could kind of plus or minus 10% of what the likely applied valuation would be. Now in this world of AI, you see companies getting priced in billions, no revenue. You have other companies growing from 1 to 5 million of ARR and struggle to get a term sheet. And so there's really no formula for how valuations are ascribed to companies. The tale of the two cities that we are seeing is a massive disconnect between experienced founders that have made VCs money and getting these massive premium valuations, and companies and founders that have not yet. And You could still, really play an important role here if you haven't been a return founder, but you're just seeing a huge disconnect in terms of the valuation described. And how I think about that is the ground underneath our feet is shifting so fast that venture investors are therefore applying a premium on founders that have been there, done that before, have talent coattails that they can bring in faster, have an existing customer network, and can move a little bit quicker as a result, thereby taking the lead in a category that emerges. And so that's just the major disconnect that we're seeing.
There's a lot happening or has happened with the macroeconomic situation. Has that affected either the investment or the valuation? What's your take on everything that's happening in the economy? Because it seems like there is an impact of how startups are getting funded.
Yeah, the U.S. economy has probably never been more dynamic than it is right now. And there's your running for office word right there, I guess, right? Dynamic. It's such an ambiguous word. But I'd argue it's much healthier than most people think. The layoffs have been lower. The inflation's below 3%. GDP prints are north of 4.5%. The impact of tariffs have actually been way more muted than I think most people predicted, especially back in March. And so I think that the U.S. economy is probably the most attractive place to have not only domestic, but also international investment in the world right now. And I think with all the AI build out that's happening, with data centers, with chips, with the infrastructure that will need to exist to unlock the new set of applications, that's all getting done and driving tons of construction jobs, lots of investment and lots of innovation.
Right. You talked about vertical applications that you're focused on. Are there specific verticals, or is it that somebody comes with a vertical solution and qualifies with all these return founder, talent pool aggregated? How are you formulating it, taking all this into consideration? Your economy, vertical outlook, vertical application, the founder, return founders versus new founders.
Yeah, there's a couple ways that we're thinking about this. So if you take a step back and see where AI is making a profound impact, it's software development, right? It's putting software developers and turning them into 10x producers. Content development, whether it be text to speech, video, PowerPoint, etc. And then the third where we really like to play is in the workflow game where there's just a lot of documents and a lot of text. And so if you look at, in our funds, we have a company in insurance automation that helps process claims for carriers. Well, what do you do when a claim comes in? You have to detect whether or not it's fraudulent or if it's legitimate. And if it's fraudulent, you put it into a different workflow where you go prove out that it's fraudulent and go recover the capital. And it's really easy to commit insurance fraud. But on the flip side, if it's legitimate, there's lots of health records, lots of data that you need to aggregate and then adjudicate how much do you pay and when do you pay out that claim. And it's a job that is very repetitive for a claims agent in an insurance company and where there's just lots and lots of bodies. Well, with software in this company called Owl that we're involved in, the AI can do much of that data aggregation, document annotation, and then help a claims agent decide exactly how much should be paid out and when. And so it just puts these business processes and brings them to be way more efficient and even way more accurate. And so you're just starting to see the tip of the iceberg of enterprise applications get adopted. Twofold is one, the security and compliance is becoming much more clear from procurement, et cetera, how you treat the data. Two, the LLMs are much more accurate now, where the accuracy actually usually exceeds a human, but the human is still required to make sure that these things are produced in the right way. And then three, the trust element. People are becoming way more comfortable adopting AI solutions as part of their everyday consumer life, which brings them into the comfort level of their work life as well. And so I think if you were looking out to 2026, we're starting to see the rise of enterprise applications get built.
Does that extend to the agentic applications part, or agentic being the core way of delivering these solutions?
Yes. Businesses buy value. They don't necessarily care if it's SaaS or if it's an agentic outcome. The way a customer thinks is, I need to buy value to a problem that I have, a business process that I have. And that solution is always going to consist of some parts human, some parts agentic solutions. But the core root of it is what is the value that I'm building? And over time, these AI solutions, whether it be agentic or agentic plus human, will evolve to arrive at the best method of delivering the business value.
Right. Right. So that sort of opens up this question, right? So you talked a lot about application layer, but on the other hand, you guys are also going into space that looks like it's from the outside infrastructure. Are there other infrastructures in the AI stack that you're looking at, leaving out the LLM, that being cornered by a few? Is there other parts of the AI stack that are just core, but just may not be immediate applications? Are you guys also looking at that as an investment possibility, or is that an investment thesis at all?
Yes. So majority of what we've done has been in the applications area and even primarily in vertical, at least most recently. But there's a whole suite of enabling technologies that need to exist for the AI economy to thrive. And so we're in a company that helps with monetization agents, essentially building the plumbing for how an AI agent company will price to the business value that it delivers, demonstrate the attribution, bill and collect payments, all while doing this with a clear understanding of the gross margin, which are highly variable in the AI economy, as we all see. But it's essentially building the Stripe or the Visa of the AI plumbing for monetization. And this company was founded by Manny Medina, who built Outreach in Seattle. It's a company that we're really excited about, but it's a layer that needs to exist. And so we're looking at the preconditions that would be required for the AI apps to actually work. We are not doing the AI research labs. The highest, most sophisticated AI researchers, their first round of funding is sometimes bigger than our fund size. And so that's not the game that we're playing. We've done some interesting things in inference optimization, funded by some brilliant technical folks, where we see them going after, enterprise scenarios where you want to lower your cost of compute and delivering value with AI without having to buy a whole army of, NVIDIA chips. And so you'll see more interesting innovation happening there because, NVIDIA is clearly a powerhouse, but, customers can only bear so much brunt with how expensive it is.
Right. So that leads to the next obvious question, which is these things are building. There's no talk about IPO in the AI market. Anthropic that's been well documented that they could go IPO, and they seem to be making moves around it. Do you see the IPO market in itself opening up? What's your prediction and take on the IPO market? Because that's a path to exit, which is at the moment seems like either get funded or get acquired. Those are the only paths that are available.
Yes, I think this year will be the year of the IPOs, especially back half. Interest rates are now at a moment where equities are more attractive. It seems like the current administration is more IPO friendly and forward, and also M&A forward. But there's just the reality is venture firms are on a clock. And by clock, I mean 10-year funds plus 2-year extensions where you got to start to get liquidity in your underlying companies. And, we're at a tipping point for many of the early 20-teen funds where you got to essentially find liquidity for the companies. And that means, do you sell it or do you sell in the second? Do you sell your shares in the secondary? Or do you start to finally push the companies to get public? And really it's, the companies that got high watermarked in the 2021 that are now finally growing into those valuations that are important for a founder's psyche to go public. And so I think the macroeconomic environment will be helpful. The timelines that companies and funds are on is a little bit of a forcing function, and that companies have matured beyond the 2021 high watermark where they can get out at the last price or close to it.
Got it. So what are companies that you are watching that might go IPO? It may not be your portfolio, but it can be anything, that could go IPO that have postponed it in that definition of from 2021. There have been some movement to get there, but something or the other hasn't worked out.
Well, I can't comment specifically on a company that's near and dear to me in Seattle from my ignition days, but that's a company that think super super highly of the iService folks, and and they've executed phenomenally well, and we'll see what their path is over the next kind of 24 months. I think the company that everyone wants to benchmark as the AI comp is Anthropic right now. They seem to have won the B2B side of things, plus the software development side, whereas Gemini, Grok, and OpenAI are duking it out for consumers. But everyone wants the comp of what is really under the hood of these companies as how I should think about the other private investments. Because right now, you get the gross margin ambiguity, you get all the CapEx ambiguity, you get the state private ambiguity, and everyone wants a little bit of certainty of how do I make sense of this new market, given there's so many variables at play. And so I think everyone's all eyes on Anthropic by the end of this year.
Got it. So this sort of goes back to this other question, right? Which is, you brought up this, they have clearly got productivity under their sights, Anthropic. I mean, like you just mentioned, they seem to do extremely well with developers, enterprises, etc. Does that shift in your mind when founders come and talk to you saying, they want to raise X, they want to raise some money. And then when you look at use of funds, seems like now the use of funds is how you're going to distribute rather than how you're going to build, right? Because it used to be 85% went into engineering efforts. Now, theoretically, Claude could do it, I don't know, fast, at least definitely faster, maybe less expensive compared to that. Does that change how a founder listening to you would come and say, hey, this is my use of funds. What's the way I will gain traction?
Yes. A simple framework that we're thinking about, or at least I'm thinking about it, is IP can now be in distribution, not necessarily in software development. So what is your IP that is in distribution if you're a founder? Because to your point, if Anthropic and these other software generation tools exist, that means the barriers to entry have just calmed down. It's more inexpensive to build a V1 product. You don't have to be as technical to get, a V1 product. So it happens faster and it invites more competition. So what is your IP that's in distribution? And that's what needs to exist to actually win a category today.
Right. It's a very interesting approach, right? Because then founding teams need that as a core talent within their initial outlook. It used to be you could get together a couple of great engineers and build something and then add the sales talent, etc. later. But this is almost the reverse now what's happening. You got to get the sales talent in first, or go to market talent. I don't mean sales in general. Go to market talent in first. Everything else.
Yeah, and I think there's just a lot of co-marketing, product-led growth. We're seeing a lot of designers, founding designers hired earlier on to deliver, just really a best-in-class first touch experience with AI, because the switching costs for a lot of these apps are next to nothing, which is always concerning. And so you see founding designers to make sure that the product experience and usability is world class day one. That is a new shift versus the SaaS era.
So the moment of truth now. Kellan Carter's prediction for 2026. First, why don't you look back at your 2025? You had predicted that the OpenAI Microsoft relationship will frail. What do you think has happened in reality?
I think in reality, the relationship is clearly important, but did fray. But they're a little bit dependent on each other. I think Microsoft was a little bit behind on much of their AI solutioning and their Copilot, and they need OpenAI to keep them relevant on that side of things. But I also think that they see such a big prize that they're so committed to figuring it out and working with other vendors to make sure they don't miss out on that prize. Meanwhile, OpenAI has developed partnerships and relationships with essentially every other cloud vendor out there. And so they've had to diversify away from Microsoft, probably to make sure, one, they have the compute capacity, but two, that they're not solely dependent on Microsoft's distribution, and that Microsoft might emerge as a realistic competitive threat from an AI standpoint. So both of them are playing like, the what is it? The enemy of my enemy is my friend. That's what it sort of feels like right now.
So it's taking longer for them to separate. It's easier for them to be together. That's your take.
Yes, exactly. We have to coexist, but we're going to compete.
Yeah. So with that said, what's your 2026 prediction?
Back half of 2026 will be the best year for IPOs in the last decade. Maybe except for 2021, but that's when I think that LPs, founders, VCs, it will be one of the best years for exits in the last decade.
Great, Kellan. Thanks a lot for your time. And as always, we always look forward to recording with you beginning of the year so that our audience can enjoy your predictions. Thank you very much.
Thank you. Always so fun. Thanks, Gary.
Hi there. Thanks for the support. Make sure to subscribe on your favorite app. Just search From Startup to Exit to stay updated. Now back to the show. Hello, everybody. We have Sudip joining us for our annual investment outlook episode. This is the third in an annual series that we are doing. Sudip, thank you very much for coming back on the podcast and doing this every year for us.
Yeah, it's always a pleasure. Thank you so much for having me.
So let's kind of start with the 2025 year in review. What was 2025 like from an investment perspective compared to the previous year? What was your focus of 2025?
Yeah, I mean, it definitely was busy, but I would say that probably it was less frothy than 23 and 24 in particular for a couple of reasons. So one was that I think we are entering that phase of the whole AI space where people are actually getting to a point where they are asking to show the money to the companies that are selling to them. So what I mean by that is, for example, we work with many, many large enterprises. And I think in 25 in particular, particularly in the second half of 25, they started really asking the hard question of ROI of all the 50 or 100 POCs they were running with AI companies. So they really started asking the money question, the ROI question. That in turn has started separating the wheat from the chaff, so to speak, meaning if you are just selling a story but not really delivering value of the ROI to your customers, think you are basically there was less space to hide in AI. So investors naturally started gravitating towards companies that were bringing that ROI, bringing that real value to the table as far as their customers were concerned. So in 2025, you probably saw this data already. The deals actually started getting concentrated. So what I mean by that, it was like bigger checks in a smaller number of companies. And I think you'll probably continue to see the pattern because you're seeing some of the winners pull away from the rest of the space because they're able to deliver the real benefit, real ROI to their customers. So that was 2025 for sure from a deal activity standpoint. From a focus standpoint, for us, at Pruven Capital, we invest in two areas. One is enterprise IT, so anything in the infrastructure, cybersecurity, data, developer tools, that kind of falls in that bucket. The second one is applications. So essentially, we invest in two buckets that large enterprises buy. I think in 25 in particular, we actually started seeing some of these companies grow up in both of those buckets. Our focus really hasn't changed much in 25. We continue to focus on companies that are delivering real value. I think whether they are real AI companies or driven by AI is kind of a secondary thing for us. It's more like they're actually providing some real value to our enterprise customers. That has been our lens. So our investment focus wasn't all that different from 2025.
But was it extremely focused in terms of AI? Without AI, there was no consideration, or did you have other considerations?
So we have a slightly different lens. Our lens is more like problem oriented, meaning like, are you really solving a meaningful problem? Are you really automating a workflow that actually delivers real value to your enterprise. I think naturally the companies that we ended up investing, we ended up engaging, they are more or less all driven by AI in some respect. Yes, they all were more or less AI-driven companies, but we stay away from investing in areas like we don't invest in companies that are building foundation models, for example. You still see those. Yes, I mean, obviously there are big 800-pound gorillas in the space, but we saw a number of companies that are trying to build foundation model for specific verticals like healthcare and radiology, diagnosis and things like that. We stay away from those because at the end of the day, we are very much focused on are you solving a real problem? Are you delivering a real solution for a use case that an enterprise will pay for? So yes, I mean, all of our investments were AI driven in some ways, but they were not quote unquote AI companies, as in building foundation model or frontier labs.
So building on that what you just said, which is you saw separation between companies, ones with real and ones that were not quite there yet. Did it have impact on valuations compared to the previous years? Go up, go down? Especially you mentioned concentration. A lot of money
Right.
chasing too few deals. How did it affect valuations?
Yeah, definitely the valuations were at a premium for companies that have started showing real momentum, real ROI, to your point. The valuations for companies that were in the Series B, C, D stages where they had real momentum, real ARR growth. And frankly, some of this, some of the old playbooks of ARR growth have gone out of the window for some of these next new generation companies. What used to be like, okay, you grow 3x, and then 2x, which was very, I would say, top decile, very good for SaaS companies, have gone out of the window because some of these companies are growing like 1 to 10, 10 to, I don't know, 70 or 100 in some cases, right?
Mm-hmm.
So for those companies, the valuations have definitely like gone through the roof. I think on the seed, at the seed stage, I would say, yes, you always, read about some headline deal where, raising, X $100 million at, X $1 billion. But those are like very few and far in between, particularly in 2025. I think I would say on the seed side, things were a little more rational than 23, 24. People were not just jacking up valuations just because it was in a great team, but only had a PowerPoint deck. So market was a little more rational on the seed, even in Series A, at Series A stage. But like I said, for more like the growth stage companies, particularly if you are the winner in that space, you could command virtually any valuation that you want.
I see. So that leads to the question of overall economy and the health of it, or your opinions on the economy looking forward compared to what the year that just went past, because there was a lot of impact on macro factors on everything that we did in our lives.
So I'm actually, I would say, cautiously optimistic about the economy in 2026. I think you read the market data, you see the market data, you track the interest rate, you track inflation. I think, I'm cautiously optimistic. I think probably at this time last year, I think there was probably, in my mind at least, a bigger fear of some form of recession, less in that camp right now, 2026. I think the one question that I think everybody is pondering, not just me, is the sustainability of this whole AI space, right? Meaning, like, if you really look at it, a lot of the activity is driven by big investments in the AI space. Large data centers getting built, which is fueling demand for chips, which is fueling obviously a lot of the stock prices we are seeing. And we have all seen this. I mean, there's a little bit of like that's a circular economy among some of the large AI companies. So I think that sustainability of that through 26, 27, I think is a question, because I think if there's any hiccup in that, that might have a certain impact to the tech side of the economy for sure. So that's one thing I think we all kind of worry about. But when it comes to like an early stage investor such as us, our time horizon is much longer, right? It's like 5 to 10 years probably for any investment we are making. Those companies to really grow up and have a meaningful business that gets impacted by economy, it's probably too far off. So we do not, for our own investments, we are not making decisions thinking, oh, there would be some kind of hiccup in the economy in 2026. But of course, we are watching because we are part of the overall venture market. I think the bigger question, IPO market open up this year even more meaningfully. I think that a good IPO market could dramatically, obviously, help the economic outlook.
So expand on that, right? Do you expect the IPO market to open up in 2026 more than the last 2-3 years?
I actually do. I think the IPO market is probably already more open than it was during 22, 23 drought. At the time, you hardly saw any company go out. Frankly, a number of companies pulled their S1s in the 21-22 timeframe. I think there are some really good companies in the IPO pipeline. You take companies like Databricks and Revolut and Cohesity and like so, and a bunch of these companies that I think in previous IPO cycles probably would have gone out already and are remaining private only by choice right now. So I do expect, again, I'm a huge fan of a company like Databricks. I hope and I do expect they go out sometime this year, right? I think once you have one of those marquee companies go out, I think you'll see a string of companies follow because the market's obviously sentiment, is a lot more positive. The reception is a lot more positive. So I think you need one or two of those marquee, iconic companies to get out and hope this is the year that Databricks decides because that will help
Right.
other companies.
But there's a lot of chatter around Anthropic might go out
100%.
in 2026. So would that set a bar or a comp for others? Because there will be no real numbers, right, when they do go public.
Yeah, so Anthropic, I'm glad you brought it up. Yes, I think we all are reading the rumors of them going out from H1 and could be giant IPO, right? Anywhere up to like $1 trillion IPO or something we have never seen. Yes, it does up the bar, but I would say in general, even in the IPO market, I think the bar is already moving up. So what I mean by that is, I think you're saying the charts and the chatter about the multiples for pure SaaS companies getting compressed already. And I think that's the direction the market is going to move, which is if you are just let's call it a database with some heuristics with an kind of an UI built on top, which is most SaaS companies, and solving a vertical problem, I think your long-term moat is at risk and the market is already accounting for that. And my point is, even if without Anthropic, you'll probably see the bar moving up for sure. I think one question there, and this is not specifically about Anthropic, there's more like the pure AI application company. I think one vector is growth, the other vector is margin. So gross margin. So I think that gross margin story is a little bit of a TBD. Like we don't really have enough data to know if you're growing from 1 to 10 to 100 million in ARR, what's happening on the gross margin side. Are you mostly like passing that on to one of the foundation model, or are you capturing a meaningful part of that? I think we will see that as some of these companies go out, and I will have a better sense. But I think you also need to have a good, strong story around your gross margin. So that's another vector I think people will have to factor in as they evaluate some of this newly public companies.
So with that said, with application companies gaining momentum, is this truly 2026 truly the year of agentic then? Because we talked a lot about it. There's not much to show for in terms of, but is this the year? Do you see that shifting or is it still in a,
So It is still in a curve. I mean, I would say one thing though, we're actually hearing this quite a bit from the corporates we work with. Multiple of them have told us, and this is coming from the CTO, chief architects, who are responsible for putting these agentic applications in production. I think the quote is more like 2026 is going to be the year of agents and the focus will not be, okay, the agents will come back in and replace whole departments of employees overnight. I think that's a very far-fetched dream at this point still. I think what you will see is very focused workflows and use cases getting automated by agents with the humans in the loop. So that's sort of like if 2025 was a bit of my entire team doing X could be replaced by a bunch of AI agents which work 24/7 and never complain about their comp. I think that is probably still we are very far away if we ever get there at all. But enterprises are looking at more narrowly scoped workflows and use cases, and definitely they are putting in agentic automations there with human in the loop. The other area where we are seeing, I would say, agents taking or gaining more traction is what I would call service use cases. So if you talk to any Fortune 1000, Fortune 2000 enterprise, normally they spend in any given year, they spend somewhere between 500 million to 1.5 billion on all of these service providers. Definitely are seeing a lot more receptivity from them in terms of, okay, if I'm sending $50 million to a service provider who have offshore human talent to do my X, whatever that might be, some kind of business process, I think the enterprises are definitely a lot more open to a new generation company coming in and saying, hey, we are still your service provider. Our interface is still humans, but under the hood, instead of having 100 humans doing your business process X, we probably have 10 humans, and then the remaining 90% is some kind of agentic automation helping those humans. And as a result, we can offer you much better quality, price. I think in those kind of scenarios, we are seeing agentic automations getting faster traction for the simple reason that for enterprises who are consumers of those services, it is actually much easier to point their business process from service provider X to a new generation agentic service provider. It is much harder for them to really adopt a tool because they need to set up a team, train them on that new tool, and so on. So that's why they are much more open to replacing their service provider with some kind of what I would call agentic service provider. Somebody said this to me. I'm still it's a little corny, but somebody said Agenture is the new Accenture. I mean, it's a corny quote, but I think there's definitely a lot of truth in there.
So this leads to the other question, right? There's been at least a lot of success reported in knowledge workers being replaced, like coding, for example, right? Vibe coding, the whole Claude really moving into the enterprise has been well documented, right? Now you talked about massive shifts in terms of productivity as agents move in, whether it's replacement or increase in volume or things like that. But looking at it from an entrepreneur perspective, right? When they come to you for early stage funding, you have a set of things you evaluate on the problem they're solving. Is it real? Is it repeatable? All that said. But it seems to me that one of the things that looks like you may be evaluating is how do they reach the customer, right? The go to market seems to have, based on what you're saying, seems to have moved even into seed stage of the very early. You almost need a go to market plan before you even write a line of code, kind of a thing, because the code can be written by Claude. I'm being facetious, you know what I mean, right?
Right.
Is that something as a trend you are seeing, and are you guys evaluating the ability to execute a go to market?
I would say is it's almost like it has always been it's not as different from the past cycles, meaning it's almost like the old is always the new kind of thing. I mean, there's something in some kind of quote like that. My point is, I think gone are the days when you'd invest in a company and expect that team to take 2 to 3 years to build their MVP of their product, right? I think, and then think about go to market. I think those days are gone for multiple reasons. One is just like you said, you can get so much more done with so little these days. Like I was actually talking to a founder recently. He had a pretty successful exit selling his previous company to Fortune 50 and did very well. And he had built the company over 4 or 5 years. And first 2 3 years of that was building the product. And then the remaining 2 3 years was obviously figuring out go to market, tweaking the product based on what he was seeing in the market. He was telling me in like a 5 6 weeks time frame, because he is still thinking in that same space. And he was saying, like, in a matter of weeks, he alone was able to replicate virtually the product that he had built in his previous company over like period of several years. And that is mind-boggling, right? And I think you'll see that. I mean, you're already seeing that in every aspect of in startup, right? So I think that is that mindset. If the founder already does not have that mindset, I think it is going to be very hard for that founder to succeed. Forget about even raising money. I would say the reason go-to-market is so important. By the way, I mean, I would always think like even in 5 years ago, go-to-market was still as important to think about when you were building the product. But it is more important now because a lot of the success of your product depends on it getting better based on the data you're collecting from your users.
Mm-hmm.
So if you don't have a flywheel
Mm-hmm.
of users using your product,
Mm-hmm.
sending you first party data that you can use to try, fine tune, retrain, whatever, your core AI, then your product is not going to get better over
Mm-hmm.
time,
Mm-hmm.
right? And then you run the risk of some other platform company coming and completely wiping you out
Mm-hmm.
in a couple of years. So I think that's why go-to-market is so much more important. It's not just to, show dollars, but also to really enhance and improve your product continuously.
Mm-hmm.
Because that is the moat that you are building at the end of the day.
Mm-hmm.
So that's why I think go-to-market, like thinking about it or actually acting on it from day one is so important or more important. It was always important, but I mean, don't get me wrong, but I think it's even more important because now your product success, your moat critically depends on you getting in front of your users.
Yeah, understood. So it's almost like you need the distribution to be built in even into your first business plan that you're thinking about. Seems like
Yeah,
that
100%.
without that, there's no chance of you getting there.
Yes, 100%. And that's your moat. And I think, in this world, probably the single biggest concern is the moat. Like, what do you have today
Mm-hmm.
that cannot be wiped out by just, the models getting better? Like,
Mm-hmm.
we all are, kind of thinking about this long context windows, right? So, for example, let's say today, you are a completely like an AI driven solution. Let's say you are taking on marketing, right? You're automating some of the workflows in a marketing team, right? So you have built almost like a middle layer on top of, whatever foundation model you're using that is very marketing specific. You're collecting your data as people are using and so on. I think the real question is in 5 years' time, will the underlying foundation model be able to do all of that without your middle layer?
Very, very good question.
So completely putting your company at risk.
Yes.
And I think that's a real question you have to ask because this space is moving so fast that you have to think about, okay, in 5 years, how do I compete against the foundation model being so much better than what they are now? I don't know the answer to that. I think in the SaaS cycle previous, decades, I think this was not a question people really thought about because at the end of the day, It does all of, okay, if I have more users, if I, get them, get their workflows in my SaaS tool, I have created my moat because I have their data. I mean, think about, Salesforce, right? I mean, it's like David is one thing that prevents people from moving away from Salesforce, no matter how much you like their UI and UX and so on. But I think in the new generation, in the coming days, I think a lot of you'll have to think about the threat from the foundation model. Also, cannot rely on being a system of record because I think that mode is disappearing or at least getting very blurry. Earlier, it used to be like you had a system of record, and that's your mode. I don't think you can rely on that anymore.
Because the interactions with whatever systems is also changing. They're coming at from humans and agents maybe in the future. You're right.
And multiple systems. Multiple systems.
That's right. That's right.
Because it is I think we built SaaS tools almost like in silos, so humans could use them. I think we are getting into a world where we are going to be workflow focused, and hence the power of the underlying system of record is going to be greatly diminished.
So now the one thing that we've been waiting for the whole interview, your predictions for 2026.
Yeah, I'll probably say a couple of things, not just one. I would say you asked me a little bit about kind of the broader market IPOs. So let me share one thought there. I think, and this is a prediction, I think at the end of 2026, if you really look at the IPO market, probably the best performing tech IPO will be a company that uses AI deeply, but is not perceived as a pure AI company. And my thought behind that is, I think 2026 will be that inflection year where AI as a category will start to almost disappear and in favor of almost like AI as a baseline capability. So think back 20 years, right? Pure internet companies, kind of disappeared as a category and internet just becomes the underlying, engine, right? So I think you'll start seeing in 2026 that being reflected in the tech IPO market. Like one prediction I definitely have. The second one, I think I'm still hopeful, but I think you will. I don't have a firm timeline whether it will be definitely by the end of 2026 or not. But I think you will see AI coming to the edge or getting to the edge a lot more. And again, internally, somebody said to me the other day, which was in 2026 gets edgy. That was kind of the quote. And I think there's a lot of truth behind that because I think the use cases are getting there where there's a lot of market pull because of user latency, user experience, data privacy, all of that reason, and frankly, even the infrastructure, underlying infrastructure, actually getting there where you can run pretty high capability in a much smaller models on the edge. And edge doesn't only mean phones and stuff like that. It could be a lot of other things. It could be your cars. It could be like edge data centers. Whatever, like your parking meters and whatnot. But I think you'll see a fair number of edge use cases coming up. So we are seeing that on the infrastructure side where people are actually working on kind of pushing AI to the edge from an infrastructure layer standpoint. And I think you'll see some of the applications evolving or emerging in 2026, at least late 2026. So I'm hopeful of that. And we are obviously very much focused on some of those use cases because I think that's where a lot of the growth could come in 27, 28 when AI gets to the edge.
Well, Sudip, awesome as always. We will track those predictions through the year, and when we come back, we will discuss more about that, see how it all worked out. So thank you for taking the time to be on it and spending your morning with us to be on this annual episode of Investment Outlook. Appreciate it.
It's always a pleasure, Gauri. Thank you so much.
Thank
it was
you.
fun. Have a great day. Bye-bye.
Yeah. I hope you're enjoying our Investment Outlook episode. This year, we invited a new guest, Joaquín from Silicon Valley Bank. We really enjoyed his insights when we met with him, and we wanted him to share the data that he has about the economy and about startups with you. Thank you, Joaquín, and thank you, Silicon Valley Bank. Hello, everybody. We have Joaquín Gallardo from SVB for our annual investment outlook episode. This is both Joaquín's first and SVB's first participation in our podcast. Thank you, Joaquín, for being part of this episode. And also, thank you for bringing some unique points of view to our audience. Why don't you introduce yourself and SVB to our audience?
Yeah. Well, I should clarify. It's Gallardo.
Gallardo,
Typo on
sorry.
my part.
Yeah.
This is my typo here. But yeah, it's great to be here. Thank you for having me, Gary. Again, my name is Joaquín Gallardo. I'm with Silicon Valley Bank, our division of First Citizens Bank. We've been around. Just a quick introduction to who I am and what we do. Silicon Valley Bank has been around for 40 years. We invented the category of tech banking. And we've been banking with the best tech companies ever since, all the way from just an idea and just incorporated all the way through post IPO. So that's the niche that we service, which is very unique, especially when it comes to the world out there of venture-backed technology companies in the innovation economy. It's a very small sliver of the big economic pie. So from there, we have very unique services, lots of white glove. And on top of that, just it comes with a lot of, expertise that comes along with it, with experience and having been in it. I've been through, started my career in Washington, D.C., worked my way through San Francisco, had a failed startup, taught myself to code, became a full stack developer, haven't coded since, which is fine. Now I have tools that do that for me. So it's been a fun.
Awesome. Thanks for that intro. So let me start with this, right? Most entrepreneurs, most founders don't wake up thinking about their banking relationship. They have some personally, or they may have had some at their employer, and then just say, oh yeah, we'll just start with that. But you guys uniquely focus on startups that go from seed stage all the way to IPO and past. What is it that is so important for a founder to consider when they need, like they're starting up their company, they're thinking of people, products, etc. they're going to build and acquire? This relationship is also important. Can you elaborate a little bit on how that is very important for founders to consider at very early stage, and how you are a partner to them?
Absolutely. So we're relationship banking. We're relationship driven. Relationship coming from the investors all the way down to the founders themselves. So in the course of everything that we do, that's the core of it. And to us, what that means is we increase the probability of success for our founders. So we love getting to know companies, what they do, work with them personally. You need a face, not just a faceless interface. You need to talk to a human being that understands what they're building and how they're building and what they're doing, who they need to talk to. And then we roll up our sleeves and try to help everyone we can, which is introductions. It's inviting them to events, to dinners, to programming, to help them along the journey. It's lonely. It's a lonely journey when you're a founder. And so we try to add light to that and help and provide resources along the way, which is unique to the founder journey in a venture-backed company. So, from that perspective, we truly are unique, and we built out that model. And then from the product perspective, we understand companies that by definition are going to run out of money unless they raise again. And we know how to lend to them. We know how to have credit cards that help advance that in terms of getting into some nuance there, but don't need to do that. But if your company is scaling and it's going really well, you're going to still burning. So your balances are coming down. So that's when you least need or want your ability to use your credit card to go down. And that's something unique that SVB knows how to, with. And that's just one example of many. It goes across the board, the different ways that you can help, that we understand as an institution through our products, how to work with venture-backed startups.
So let's kind of go into the outlook for 2026, right? What does your institution see from a macroeconomic perspective? 2026 will look like for founders. I mean, we let our audience is a good mix of founders and investors. So, from a founder perspective, what as an institution you guys are looking at and forecasting and saying, "Hey, this is what 2026 is going to look like," and these are the categories that might be of importance.
Yeah. So there's the superficial view, and then there's what's happening under the hood. And what's happening under is messy. There's a lot of things changing in the ecosystem through and through. Right now, we're entering one of the periods of time when it's been most, from an investor fundraising perspective, unequal. You can have Andreessen raising $15 billion, which is phenomenal. But then the bottom 50, it's wrong to say bottom, but the funds that are much smaller, that have a different focus, they are not getting as much funding. It's sucking the oxygen out in a way from the LPs as as the LPs themselves are figuring out their allocations and also looking for a return. So it's the IPO window has been a little open. And actually, we were kind of surprised. It was much more open in 25 than we thought it was going to be at the beginning of 25. So that's going to lead to a lot more capital recycling through the system and funding more venture capital as well. All that to say that in 26, we're expecting more funds to close. We are expecting that to go up. We're expecting slightly more in terms of what we're forecasting for Series A venture deals. 25, we saw about 6, and we're expecting 1,500 to 1,600. So about the same equal in terms of Series A venture deals. And there's how much, at what valuations, and how that's shifting and adjusting as well. But across venture deals that are less than 100 million, which is important to call out that, excluding the outliers, we're expecting about 10,000 of those in 26. And in IPOs, we forecasted 10 IPOs in 25. We saw 21. And in 26, we're forecasting 30. Again, we hope that we're underestimating it. We're expecting some big ones and more capital to be recycled in the system. So, there's an optimistic take here. In general, we're seeing forecasting of about 2 rate cuts this year. We'll see how that ends up. There's different political macro to be considered and how that plays into it. The data that we see, can be questioned depending on where it's coming from. So what it really ends up being is who knows? I certainly do not. That kind of uncertainty aside, I definitely see an optimistic future for 26 and where we go.
Oh, that's great to hear. You have you're a little bullish on the IPO market for 26 compared to 25. So more could go up. This leads to this question, right? In this age of AI that we are all in, do the IPOs that could happen in 26, do you guys expect that to be a comparison for how the valuation of startups could be affected, meaning the unit economics may be known because of filings. It could be the growth could be known because of filings and disclosures. Would that affect valuations? Or do you see that in the age of AI, the investors are valuing them for being in AI?
I think what you're alluding to is that there's a premium. If you're an AI company, there's a promise of a future that you're investing in that is popping up. But then when you put, rubber meets the road, where is that real value and what is that as a multiple of, their actual revenue? The valuation of OpenAI versus its actual revenue is it's an outlier. So the answer is yes. And I do think that there's an exuberance that went into these evaluations. And I understand part of the reason for it, where if you have the conviction that this company that you're investing into is going to be this category defining, creating leader, then there's a premium to that. That's like the AIs. Then you invest in that, assuming that's the case, and still think you're getting a deal for it. Now, whether that actually pans out or not, that's just part of venture. When you have one or two companies that make it out of your portfolio, that may returns the fund, and that's the model. So that's a kind of long way of saying that yes and no. And then as that plays down to the earlier stages, that becomes more interesting. You could have more muted valuations at earlier stages. But again, that's also when you're investing the most into that future dream. So it really does depend. Just a great non-answer.
No, but this sort of opens up, right, the question, as you look at the landscape, because you see multiple startups come through your door every day, right? Anecdotally, we hear higher levels of funding and valuations for early stages, right? So the question is, from your data, do you see that earlier stage AI startups are getting more funding or getting higher valuations than normally? That is normally, as in going back a few years, where there was, if you already say, there was some formula that everybody worked towards, right? There was investors either decided that I want to own this much or that much. But seems like all that has changed. Does your data reflect that, especially for early stage companies?
Yes, valuations have gone up. Yes, that could be inflation. That could be, there's a bit of it that was AI, but it doesn't feel that way anymore. I think the market that we serve anyway here in the state of Washington, there's a lot more groundedness to the investors and the expectations of the founders. So while you still have a few really large seed rounds, there's, in general, to me, it seems that AI has reached a convergence with what would be traditionally considered just enterprise, SaaS, B2B kind of investing. And so it's using an application, it's using a technology, but it's the same way that you would utilize cloud or sell into that and mobile before. And I think where we are is we got through the exuberance and now we're in like rubber meets the road, but it's almost like everything is AI. So like just investing in AI, and that seems to be like another word of saying enterprise SaaS or whatever that model happens to be. And so then you are seeing more of the traditional metrics coming through. Part of that too is VC driven in the sense of, you come to a thesis, you have a check sizes that you can write for a target equity ownership. And from there, you can back into the maximum that you can value a company before you're not able to write a check per your LP. So you kind of, you end up in this situation where depending on how in general, you're still kind of constrained based on those expectations.
Right.
But valuations are going up.
Well, that's actually the good thing. If you're a founder, it's worth noting the valuations are going up. This leads me to this other question, right? In this area, in the geographic area, in the past, we have skewed more towards enterprise SaaS or enterprise B2B startups as opposed to direct to consumer or B2C or any of those, right? Do you see that from what you guys are viewing every day, AI has changed that mix in any way? Meaning, because coding is not the mode anymore, getting your word out may be different than before. You could do a lot more. Do you see the area shifting away, or at least not shifting away, at least seeing any movement up in terms of consumer startups as opposed to only B2B startups?
I'll speak for myself.
Yeah.
I think that part of the challenge AI has experienced
Mm-hmm.
is you can make rational arguments to enterprise and say, here's my ROI. You can create this efficiency. You can argue for why it's
Mm-hmm.
worth paying for the product.
Mm-hmm.
In behavior
Mm-hmm.
and with AI, there's behavioral changes, not just on a business process flowchart,
Mm-hmm.
but your day-to-day behavior as a human.
Mm-hmm.
So that ought to be easier to rational enterprise buyers, but that's still hard.
Mm-hmm.
As you say, change your actual process of your job function.
Mm-hmm.
And for a consumer,
Mm-hmm.
it's another step to difficulty to change behavior.
Mm-hmm.
And I think ChatGPT definitely has led the way. Part of it is the limitation of human imagination. Like AI can do a lot for you, but a lot of that depends on your creativity to prompt it to do something for you.
Mm.
So all that's back to saying that I think that consumer AI is harder for me to understand than the enterprise AI.
Mm. Mm.
And
Mm. Mm. So you've been a founder before. So you've been on that journey, and you described that a little bit in your introduction. Put that founder cap on for a second, right? And think you're getting started in 2026 at this point. What would be the approach that you would say founders should take, that now when they come to an institution like yours, they'll say, "Yep, that's a viable founder that we can get behind." Forget the idea itself, right? But you still need the founder to execute. So since you've been one and now you're evaluating them, uh, go back to being the one you were and tell that founder that you were before, what would you do differently for the institution, given all this AI impact that we're having in day-to-day lives?
well, this is going to sound, I love founders that talk to their customers and
Mm-hmm.
get feedback, aren't afraid
Mm-hmm.
to launch or make a mistake,
Mm-hmm.
and then iterate.
Mm-hmm.
And that feedback loop is the most virtuous one that is founder at the
Mm-hmm.
early stages. So when I see that, I see someone that can pivot, that can take feedback, and is able to, you walk into starting the startup because you have some insight or something that you're solving for, but then that feedback only makes you better for doing that.
Mm-hmm.
So you already started at a place where you have a unique insight and can solve something. And then you take that to the next level. That extra level is the moat.
Mm-hmm.
And so that's what gives me the most confidence in the founder.
Right. That's good advice. Shifting back to the outlook itself, you guys went in, looked at 2025, and when you said this would be what 2026 looks like, could you specifically talk to what the region experienced in 2025 and what you guys have as your outlook for 2026? Because you have a unique regional point of view that I think would be very valuable. And when I say region, I mean the Pacific Northwest region that you guys serve.
Absolutely. So we saw massive growth, and I feel like as in 25 versus 24. It at the seed stage went from it stayed about the same actually. Pulling up some numbers here, about 500 in funding at seed and pre-seed, and then versus 524.
Mm-hmm.
But in 24, I definitely have I had a very pessimistic point of view of what 25 would look like.
Mm.
I thought we used the word seed apocalypse, where we thought all these companies raise a seed and everybody's going to be trying to raise their A at the same time and something is going to happen. But the investors stepped up around Washington. In Series A in 24, was 850, and in 25 was over $1 billion in Washington. And a lot of that is because a lot of funding came from out of Washington. I'd say Washington is a net importer of investor dollars. So I would advise any startup around Seattle to talk to your local VCs, of course. They understand you and your market and where you're trying to sell the best, but also talk to VCs from outside of Seattle because they really like the talent and the opportunity that's here. So there's, so I would definitely say that. And then, Series B, similarly, in 24 was 850 about, and then in 25 is 1.26 billion. Yeah. So companies are graduating. I'll say that they are graduating. There is more funding going into it, but it is a lot more rubber meets the road. It is a lot more of like, okay, where's that revenue? And the graduation rates are they're still kind of anemic. You're seeing a lot more between rounds, a lot more extensions, which is honestly perfectly fine. And that's just part of the process. I'll also add that these numbers don't capture absolutely everything. There's a lot that are undisclosed and unannounced. And folks prefer to fly the radar, which is fine. Totally understandable. But let's say in 21, if you had a Series A company trying to graduate to Series B, in 24 months, about 1/5 of them would have graduated.
30%.
In 24, and this is as far as the data kind of goes for that metric because it hasn't been 24 months since 25, but in 24 it was 12%. So you'd expect in 2 years to graduate, but that graduation rate has been going down. And part of that is like, okay, the extensions and, pivoting with your own AI and so there's some of that for sure. So I'm kind of interested in how the graduation rates are going to shape up through as we look back in 25 and those that have raised.
Even though there is increased dollars in 25 in A and B, which means the company started before that, right? I mean, they started the 23, 24 timeframe, etc. It seems like there's concentration from what you just said. There's concentration in a fewer number of companies with a lot more dollars, right? Because if the total number of companies were to have come down, graduation has come down, that means the ones that survived got more. Or ones who raised money, I would say raised money, got more. That's a very interesting perspective, especially given that you made the comment that we are a net importer of investment dollars in the area, which means others are coming and looking for things here. Extremely insightful data there. When you look at the data, are there particular verticals or vertical applications, or is there gravity towards, hey, I'm going to go do this, or more, you find a ton of them trying to solve for a vertical or a particular area, sector, etc., than ever before? Because it seems like in AI, I got to solve for this, right? Or versus that. You guys have this aggregate view compared to others.
Yeah, I'll say I'm seeing a little bit more of like platform technologies coming out of the area. So it's the companies that build something so you can then build over that. And that's been really exciting to come out. That to me is more category kind of technology that you're not building, you're building to make building easier or better. So that's been actually kind of interesting, and I kind of expect to see more of that. The stat that I like to say is that the Seattle area has 24% of AI engineers, and we don't have 24% of the unicorns in AI. So I do think in general that we will have that, and that's where it's gonna come from. I think that by and large, that kind of thing takes a lot more, like you're trying to hit home runs. You're trying to hit home runs when you build those kind of technologies. They work or they don't, and they take a lot of investment up front.
Mm.
In between, we're also a city that likes to just hit the doubles, singles and
Mhm.
doubles. So it's like, I want to solve this problem. And it's basically an enterprise company that uses AI to solve the problem.
Mm.
It's and that those companies are going to do great. But they've always been here. We've always been that kind of town. And that's not going back. I'm just seeing more of like, okay, there's that other category that's been growing here.
Got
And
it.
honestly, I think that's what's drawing a lot of the outside dollars.
Capital. Right. In capital formation, right, there's founders tend to move towards equity, right? They may raise through a convertible debt instrument, but the fundamental idea would be to eventually convert it into equity. As these A and B rounds become bigger, as you pointed out, that they, as in concentration was happening, do you see a role for debt even in early stages at this point? Or is there an increase compared to some time before?
I'll answer this in a couple ways because it changes when you're talking about AI or when you're
Mhm.
talking about another, if you're talking about frontier tech
Mm.
or space tech, something that has physical capital requirements, then you
Mhm.
want to augment and really think about your capital stack.
Mm.
So part of what's unspoken is how space tech has and frontier tech around Seattle has just exploded. There's a lot of really notable companies based out here, whether it's like Stoke Space, StarCloud, Starfish, these companies that have, raised significant funding, but they have a lot of capital requirements.
Mm.
You want to think about that these things start coming more to mind on
Mm.
how you use equity dollars.
Mm.
So if you're buying a CNC machine or you're buying like a piece of equipment, then you probably want to finance that simply because you want to spend your equity dollars to build the IP, the real value drivers of the enterprise.
Mm. Mm.
So from that perspective, yeah, you definitely want to think about that. But primarily what we're seeing, like when we think about AI, we think about, how does the bank help in terms of venture debt? So coming alongside a venture round, extending runway.
Mm.
But the reason to extend runway is because you're adding gasoline to the fire.
Mm. Mm.
If you hit, the investors say, we want you to hit, $2 million of ARR so that you can get to the next round, financing yourself another 6 months in order to grow that to 2.5 or 3 will get
Mm.
you a much better valuation at the next round, which
Right.
saves off dilution and equity costs and all that. And the
Right.
cost of it is it's just debt pricing, which is bank pricing, which is super cheap. So relative anyway to equity.
Mm.
So we are seeing that.
Mm.
And I'm excited about it.
Mm.
The main thing is that you don't, you want to be cognizant on the use of debt, and the VCs want to know the bank. Being around for 40 years and knowing exactly how we operate
Yeah.
is super helpful.
Yeah.
But primarily you don't want to use debt if just to extend runway
Mhm.
if it's not working, because
Mhm.
then you belong to the inevitable and your time is better spent with a new enterprise.
Mhm.
So, so it's understanding what the nuances there are.
Mm.
And when it comes to AI being capital efficient, means that you get to think about it more in terms of the true runway extension for your valuation and timing on the next round.
Awesome. So all our guests make predictions for 2026 for this particular episode. I'd like for you to make 2 predictions.
2.
You're the only one who's going to get 2. One,
Okay.
your personal prediction, because you've been an entrepreneur, so I'm very interested in understanding your personal prediction. And then a prediction based on the data that you see as an institution, right? Those are 2 different things, because I'd like to get both of those. And so you're going to make 2 predictions, then we'll come back at the end of the year and record another one and see how those came out.
Okay. There's going to be a muted AI bubble pop. And that's my personal prediction. I think that, I keep saying rubber meets the road. Like there's an exuberance on technology and what it can do, but it's not going to be super impactful. It's just going to be something that happens minor correction here or there, but it's not going to be category destructive.
Mm-hmm.
So that's one prediction.
Mm-hmm.
That puts us on the right path, ultimately.
Mm-hmm.
Then my second predict, there's been a lot of talk. This one's spicy.
Mm-hmm. That's good. That's good. That's all we want. Hot takes.
I think that there's been an overexuberance on like dual use investing, and a lot of folks are going to get burned on what that means. And I think that will start to temper down, and VC investing will focus on what it should always be focusing on, which is building generational changing technologies versus selling to government.
Very good. Well, first of all, thank you very much for participating and enlightening us on your role with Silicon Valley Bank and also Silicon Valley Bank's role in our region. And thank you very much for both. And we look forward to more of your bank participating in our ecosystem every day. Thank you very much.
My pleasure, Gary. Thank
Yeah.
you so much for having me.
Thank you. Yeah. Thank you for listening to our podcast from Startup to Exit, brought to you by TI Seattle. Assisting in production today are Isha Jain and Mini Verma. Please subscribe to our podcast and rate our podcast wherever you listen to them. Hope you enjoyed it.